Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it's November 29th. Hope you guys having a wonderful morning thus far. We got a lot to go over today, so we're going to jump right into it here on the economic calendar. And we'll start off with, of course, every Thursday we get the weekly jobless claims. So last week we had 224,000 people apply for unemployment. That was an important number because that's last week, the previous reporting was a sample week. And what that means is that's what the BLS is going to use as part of their formulas when they calculate the jobs numbers for the month of November. So when we see the job numbers in November next week, that will be part of the formulas that they use to calculate those numbers. Forecast is supposed to be kind of in that same range at 220,000 for this reporting here, and these are for obviously last week, and it came in at 234,000. So these are still historically low numbers, but we are still seeing a trend here that things are climbing upwards a little bit. I've noticed. So last few weeks we've been like the teens, and it kind of went to 20s. Now we're at the 230s. So this is something we definitely want to keep an eye on. This could be, if this continues to be a trend, this could be, a turning point in the economy where we kind of go the opposite direction. Obviously, start going into recession, so that could be the beginning. So this is something definitely we want to keep an eye on, and we've been kind of forecasting a recession probably next year or two on these primarily because we're raising rates so much. We're getting to a point where we're going to be at negative yield curve, and typically we have a negative yield curve. Traditionally, what will happen is we go into a recession. What that means is that negative yield curve is when your short-term rates are higher than your long-term rates. Also, once you hit your lowest point in your unemployment rate, which I'm sure we got to be pretty close because we're in the threes. At some point, within 6 to 8 months, typically they say you'll see a recession. So at some point, we're going to start seeing that go up again. So again, these are just some cues we want to pay attention to if these are becoming trends or not. And on a global level, we're seeing a slowdown. U.S. so far are looking like it's pretty strong, but again, these are some clues that we want to keep an eye on to see if that could be coming to an end or slowing down a little bit. All right, let's move on here. We got a lot to go over. We got personal income for the month of October. So in September, income went up 0.2%, but forecast for October was supposed to go up 0.4%, and it exceeded that 0.5%. So people are making more money, obviously, which is good news. Consumer spending, October, so September it went up 0.4%. Forecast was supposed to be 0.5%, and it went up 0.6%. So people are not only making more money, but they're spending more money, which is basically how it helps the economy grow. If the people aren't spending money, the economy's not growing. So this is obviously a good thing, and people are feeling better about making more money. Personal consumption expenditure, also known as the PCE, this is the Fed's favorite gauge for inflation. This is one of the two consumer-based inflation numbers that we look at: CPI number and PCE here. And the PCE is the Fed's favorite gauge. Now we had a 0.1% increase in the month of September, 0.1% forecast, and it went up 0.2%. This remained at 2% year over year, so the 2% year over year remained intact. However, when you strip out food and energy, we get what they call the core inflation or core PCE, and we had a 1.1% growth in September. Forecast was calling for 0.2%, and it basically came in only 0.1%. However, this one went from a 2% year over year to 1.8%. So core dropped a little bit. And that's really what the Fed will look at is the core inflation here, and this is what's going to be important. Now it's still in line with what the Fed wants. Their target rate is at 2%, but we're still seeing a growing economy with inflation still pretty tame. So it's going to be interesting to see moving forward. Now, the reason yesterday we had a big rally in the markets, both the mortgage-backed security as well as the stock market, and he did touch on that they liked what he heard, but they do expect another rate hike coming in December. There's a forecast for possibly 3, but the feeling is after his mention is that we're nearing the neutral term where we might reach an end towards the rate hikes. So where he gets to the neutral. So might be 3 more next year. We don't know for sure. We'll have to take it meeting by meeting. But in any case, they were feeling a little bit better and they rallied quite a bit. The Dow closed up over 600. The mortgage-backed securities closed up, I think, 60 or 19 basis points, so we had a nice little rally yesterday. So keep that in mind. Pending home sales, moving along here, we had a 0.7% increase in the month of September. However, October wasn't so kind. It dropped 2.6%. Rates were a little bit higher at that time period, so we had they kind of spiked at that point. But in November, rates have kind of crept down, so we'll have to kind of wait and see. However, on my side of things, I've noticed a lot. I did check out some open houses this month, and I didn't see people there. However, I am noticing a lot more properties going into escrow. Here in California, we have escrow here, and I've noticed a lot of people sign contracts. And I even have one client with on a multiple bid offer here, one of their clients. So I'm kind of anxious to see what November is going to look like next month when we see the pending home sales for November. Last but not least, we got the FOMC minutes being released later today. That one I don't think is going to disrupt the markets at all, as we heard from the Fed chief yesterday. So whatever he said yesterday is going to pretty much trump what we would have seen on the Fed minutes from the last meeting here. Let's jump ahead here to the headline news. Stock market is down today. They're kind of putting their eyes towards the G20 summit, which begins tomorrow. And at that summit, this could be held in Buenos Aires, Argentina. At that meeting, it's expected to see Donald Trump and the president of China meet, and hopefully, investors, of course, are hoping for some type of framework to be negotiated towards a pact or something to be agreed to avoid these extra tariffs that we've been hearing about that could be putting in place in January. So, a lot of things. There's talk about either 10 or 25% on another 260 billion. They even thought about maybe adding iPhones and such and laptops being imported from over there to be tariffed as well. So those will be, so investors, of course, want to see some type of agreement or some type of deal kind of come into place here between the two countries here, especially with China having their economy is already slowing down, showing signs of slowing down, and that's kind of slowing the rest of the world's economy as well. Let's kind of jump ahead here to the bond market. Bond market, as you can see, we're down for the day, but we're still up about 8 basis points currently right here. We're going to see some better pricing coming out today, as it did start up a little bit higher, and we had that kind of trend going upwards. Now, again, we have to be careful here, even though we got some plenty of room here, but we're still in about this oversold or overbought position here on the stochastic here. So we do want to be careful because this could be quick and can change quickly here. But as you can see, we've had long patches here where we've been in over, kind of stay in that position for a while. So we just want to be one finger on the trigger, so to speak. Treasuries, same way. We're in an over sold position here. We broke below this resistance here, this floor of support yesterday, which was pretty strong. As you can see, we tested quite a few times and broke below it after that Fed announcement, after the Fed chief's announcement. And then it started testing this out at 3.01 level, which is now the 100-day moving average, and pulled back. So we're currently sitting just around 3.03 level here on the 10-year Treasury here. So again, interest rates are a little bit better today, which is obviously good news for those who are out there buying houses or looking to refinance. So, but if anything changes, like the FOMC minutes or anything that pop up here, I'll be putting that on Twitter. You can follow me at Mike Bjork. You guys have a great rest of your day. Thanks so much for watching. We'll see you guys tomorrow. Bye-bye.